Hello everyone, welcome to our discussion of our part 2, if you will, of our discussion of chapter 13. This is the second topic. In chapter 13, the alternative minimum tax is kind of a topic all of its own. No real good place to discuss it, so they put it in chapter 13 with our discussion about passive activity losses and such. But this is a separate tax system. It's designed to make sure that even those with lots of deductions still have to pay some amount of minimum tax. That's why it's called the alternative minimum tax. And what you do is you recalculate everything. So you always do the alternative minimum tax after you've done everything you've learned about the regular tax system. So you calculate the regular tax using your itemized deductions, all that kind of stuff. Figure out what that is, and then you go back and redo it using the alternative minimum tax rules. Now, fortunately for us, at this stage, the differences between the regular tax and alternative minimum tax aren't as big as they used to be. So many of the rule changes in the law in the last few years have reduced the amount of differences, which makes our life a lot easier. So this is what you would go through after you've done the regular tax. You start with your regular taxable income, not AGI, not adjusted gross income, but taxable income. So you've subtracted out either the itemized deductions, okay, all right, or you subtracted your standard deduction. So that regular taxable income, okay, and then you add back, okay, the standard deduction, or if you use itemized deductions, you add back the one itemized deduction that is not allowed for alternative minimum tax, okay? Then you do plus or minus adjustment and tax preference items. These are usually items, many of them are kind of obscure, but some of them affect a lot of taxpayers. Typically, what it does is it makes your alternative minimum taxable income higher than your regular taxable income. So most of the time they're additions, but not always. Sometimes they may be an addition one year and then a subtraction the next, or so forth, okay? So you go through that, and they're listed on the form, and we'll take a look at that 6251 in a minute or two here and see what that looks like and what those are. Then you subtract the AMT exemption amount, and the AMT exemption amount is dependent on your filing status. And once you've done that, and it's a significant amount, it is not a small amount. It's not even as small as the standard deduction that we're used to for regular tax. It's a big amount, which means that most taxpayers, their exemption amount is way more than what their taxable income is at this point, even with these additions and such. So once you've got subtracted that one exemption amount, then you, based on your filing status, then you multiply by 26 or 28% and subtract out the difference of 4122. This is how it's described on the actual form. That gives you your AMT, your alternative minimum tax. Then you subtract the regular tax. So you subtract out, so that's why you can't do AMT until you've done your regular tax, because you don't know what that second to last step is. And then that equals this AMT. That's your actual alternative minimum taxable tax amount. And remember, it's above what your regular tax is. So, adjustments. Some of the limits on itemized deductions. It used to be several of these. However, the only one that's left after the 2017 Act, okay, is that taxes are limited to $10,000 on Schedule A, but you can't deduct those on your AMT. So you're going to add those back. Your taxed state and local income property taxes that are limited to $10,000. So the most you'd have to add back would be $10,000. That's the most benefit you would have gotten, regardless of what you paid in those taxes. Now, some other things that could come up, there's some differences in how we calculate depreciation. You'll remember back in Chapter 6, that's pretty complicated. Fortunately, if you use the bonus or special depreciation or Section 179, you don't have much adjustment, okay, because the AMT doesn't get rid of that. But if you use regular property, there is some adjustments, but a lot less than there used to be. Okay, so for instance, real property after 1998, there's no AMT adjustment. Okay, you may still have property from before that, given the fact that you depreciate real estate for a long, long time. Okay, and then personal property, there is some difference, but again, not as big as it used to be. Okay, so this is usually means that your depreciation is lower if you're using regular depreciation for AMT purposes than it is for regular tax, which means you're going to have a higher income for calculating alternative minimum taxable income. All right, so gains and losses, because you're going to depreciate it and that's how you determine bases, then you could have difference in your gains and losses. Incentive stock adjustments, and one that comes up, when people are given stock options, they get the ability to buy stock at a lower price than everybody else. The amount by which they can buy it cheaper is not part of regular taxable income, but it is added to your income in an alternative minimum tax land, if you will. Okay? So that is a situation where you haven't even bought the stock. You just, the fact that you bought the stock, you haven't sold it, you don't have any gain on it yet. You bought the stock, but you bought it for less. So the AMT adjustment is the difference is going to be added to your AMT. Okay, you could have some adjustments flow through from your K1s. There are some differences in long-term contracts. Okay, but most of the tax preference items have become less important. Some things having to do with oil and gas leases and things like that, all right, are the differences. And they become less and less over the years, become less complicated. The exemption amounts for 2022 are given here. If you're single, $75,900. I told you it was a big, fairly sizable amount. Married filing jointly, $118,000. Literally, if your income is, isn't over $125,000 or so, there's no way that the alternative minimum tax is going to impact you. Okay, married filing jointly. Single, it could go lower. Okay, married filing separately, obviously, also much lower. Okay, those exemptions go away even if your income is high enough, and this is quite high income, $539,000 for single, over $1 million for married filing jointly, and that's when you start, okay, to reduce this exemption amount. So by the time you're having income, $1.1 million or so, you're going $1.2 million, you have no exemption. Here's the thing. The tax rate for alternative minimum tax is 26% or 28%. Okay, 26% on the first tax bracket, 28% if your income is over that, after you calculate the alternative minimum taxable income. That is a fairly low rate compared to the highest tax bracket for regular taxable income. So regular tax, the tax bracket is 34%. That's much higher. So this is not going to impact people with hundreds of thousands of dollars, maybe even millions of dollars of income, because they're already paying a higher rate of tax. Even if they have some significant deductions, it is not going to lower their taxable their AMT low enough so that they get a benefit, okay, from the regular tax situation. So this is really for people in a kind of a middle range, higher, I should say, upper middle range, from 150,000 up to $400,000-$500,000, unless it's a very unusual situation. Okay, that's where it tends to impact folks, is in those areas of income. So let's go to quickly quickly how the form for the alternative minimum taxes. So this is a form you'll fill out separately from your 1040. Okay, it brings income, taxable income. There we go. Now you can see it. Taxable income over from your 1040, starts in one and then starts to make the adjustments we talked about. And you'll see some of those that we mentioned in the slides. Okay, incentive stock options, taxes from your Schedule A, okay, or your standard deduction. So if you read that carefully, lines, either Schedule A, line 7, which is taxes, or the amount from the 1040 line 12, which is your standard deduction. So you start with taxable income. After you've subtracted all your deductions, you add back the deductions that don't count for the alternative minimum tax. Okay. Some other differences are all listed down here. Then you get to your taxable income. Then you subtract that one exemption amount that we mentioned. Then you calculate your tax on it. If it's under 206,000, okay, you just multiply by 26%. If it's over that, now this is after the exemption has been subtracted, then you multiply by 28% and subtract 41, which is basically the same as multiplying the first 206,000 by 26% and 28% on everything over that. We will not have any alternative minimum tax foreign credit. That's our tax. Then we compare the regular tax and we get our actual AMT. All right, so that's how the form works, process works. Again, not as doesn't affect nearly as many folks as it used to, but it's still kind of a thorn in our side, meaning that we have to consider the possibility with those with higher incomes that they could be subject to this, depending on which of these different adjustment items they have in their tax situation.